So the rapid rise of AI is going to see capacity scale to 190 gigawatts from 49 right now. That's according to our friends at Futurum. Now, the high end of their work says 215 is actually possible. And that translates, folks, into trillions and trillions and trillions of dollars of investments. Now, it sounds amazing to some, but even far-fetched, but this cycle has been in place for a long time. In fact, think about this. It goes back to the mainframe, 1970. Look at this. Every 10 years, right, the cycle, 10 times more compute. This has been going on for 6 decades now. Maybe what's amazing to me is all the folks out there who actually lived through all of this and still consider what's happening right now to be something of a pipe dream. Now, as a student of financial history, I've made the comparison many times of AI and this whole build out to the railroads and the second industrial revolution. And of course, there was a lot of speculation, right? In fact, it was rampant. The result was 4 panics, folks. 4 times the market, the economy imploded. 1973, this one led economists, the economists think that this was the first Great Depression that we had. But I got to be honest, I don't see Elon Musk or the other key players as modern day Jay Cooks. And I'm confident there isn't the same level of contagion out there. Now, on the flip side, just as the internet continued to change how we live and work long after the dot-com bubble popped, we will be reaping benefits from AI for decades and decades to come. So it's reasonable to ask whether AI is too high in the short term. All right, we have a great chart that we're going to show you about that. But it's been a huge mistake, really, to bet against the AI evolution, as you can see right here. My next guest has been betting on and been winning about this AI stuff for a long time. I want to bring in now Jay Hatfield, CEO of Infrastructure Capital Management. Jay, so here's the chart. This is since ChatGPT, and overwhelmingly, the blue part is the AI-related stocks, 70% of the rally, $23 trillion in added value. Yeah, this is not okay, but the thing that bugs me is that Wall Street has spent a lot of time dismissing or underestimating the blue part.
Mm-hmm. Well, I think there's 3 things to focus on that justifies this, and that is earnings, earnings, and earnings. And I wasn't around for the railroad boom, luckily, but I was around for the internet boom, and that was had very little earnings growth. In fact, most of the companies went public were losing a lot of money with no prospects of making money. This is the exact opposite. It's really hard to keep up with the earnings growth. In fact, as preparation for this show, I redid our target and says, well, now our base case target's 8,200 and 9,000. Why? Earnings are up 13% in 4 months.
Right. And speaking of which, last time you were on the show, May 14th, this is the moves that these names made that you gave us alone. So these stocks are making parabolic moves, and what do you do with something like this? Do you hold on to them? Do you sell them? I mean, what do you do? What are you doing?
Well, these are all big holdings in QVol, our NASDAQ income fund. And in fact, that's sort of like the earnings estimates with these numbers. Marvell's actually up now way more, and the other 2 have come back. So we are trimming Marvell. Our target's 350. Last I checked, it was about 310. So it's definitely getting pricey. And I would always look at valuation, not just momentum, but we're going to play the momentum up to 350. The other 2 stocks are not overvalued. They're being shorted by people playing hardware because it's a good hedge to that. So we're sticking with those.
Okay, I want to ask you about this bond issuance, right? So just like the railroad speculation, led to all those panics. Some are saying you've got these bond issuance which are out of hand, circular financing, and now, of course, you got Google with this equity offering. Could that be setting up a similar scenario?
We think not. We don't believe in free cash flow as a critical element. We like companies that are investing with great returns. Everybody was shorting Amazon because they have a lot of CapEx. They're going to get great returns. They're not going to agree to spend that money without great returns. Same thing with Oracle. They're going to delever next year. Why? Because they're investing and getting great earnings. So as long as there's tremendous earnings, that will support the credit for the bond issuance.
Talking about a couple of names that you like here. Microsoft. So Microsoft had that nice pop here just from the Computex commentary and the AI agents on laptops. But again, it's pulling back sharply, and it's trading more with the software names, and it feels like it's bigger than that, but it doesn't trade like it's bigger than that.
Well, if you notice, we don't really want to go right into the teeth of the hedge funds and buy a pure software company. So we'd rather have software and enterprise software that's mission critical. And so that's why we like Microsoft and Oracle, because you get the cloud business. We think when you're a cloud service provider, you have much more sticky business. So Microsoft is going to go down every other day. If Broadcom beats tomorrow, then it'll probably be down. If they miss, it might be up. So you have to deal with that volatility. But in the long run, we think it's worth a lot more.
So Jensen says that Marvell is the next trillion-dollar company. At the time you said it, that means it would have to go up 300%. I saw your note. You say you prefer Broadcom, no, which to your point, reports after the bell. We've got just 30 seconds to go, but the volume's coming on and the stock is going up into these earnings, which shows a tremendous amount of confidence.
Absolutely. So we recommended Marvell when it was at a half peg, and Broadcom was trading about 40 times earnings. Now it's reversed. Marvell's at almost 50 times earnings. This is at Broadcom's at 26.
Right.
Still has a great business, more diversified. So we have a 35 target multiple. It's at 26. So, always risky to own a stock into earnings, but we think the risk reward is very positive.
And I mean, again, if it were to pull back, you got to believe the numbers going to be phenomenal. You got to believe the guidance is going to be phenomenal. And one thing recently, these numbers, a lot of these earnings have been rewarded. They've been up huge the next day. You've been killing it, man. By the way, love the new suit, new haircut. You're looking really good, just in time for the summer. That's a guy who's making a lot of money. Liz Clan